Types of investments. What will make you the most money? Hey guys, today we're going to know what type of investments will make you the most money. Let's get right into it. Number 6. Index funds. Index funds, like mutual funds, are a type of stock investment that diversifies your investment across multiple stocks. The distinction between index funds and mutual funds is that index funds are passively managed rather than actively managed by a money manager. Because index funds are managed passively, there are fewer fees involved, which means you could earn slightly higher returns than with a mutual fund. However, your returns will be entirely determined by how well the index your fund is tracking performs. Given that most major indexes are used to track overall market movement, they perform about as well as the overall market in the long run. In other words, they typically produce an annual return of around 7%. While this isn't as high as the returns you can achieve by successfully picking individual companies with the right research, it is a respectable return that is significantly higher than savings account interest rates or bond return rates. When you invest in an index, you are essentially betting on America's future. If you believe the American economy will continue to grow, you should be fine. The issue here is that if you invest in an index and we enter a recession, the market could be down for an extended period of time. That means your portfolio will be down as well, and if you're too close to retirement to wait for things to turn around, you could be in trouble. Another advantage of investing in individual companies. Even in times of economic downturn, the truly great ones tend to outperform. Number 5. Mutual funds. A mutual fund is a type of investment fund managed by a money manager who invests your money on your behalf and seeks to maximize returns. Mutual funds are typically composed of a mix of stocks and bonds. However, they carry less risk because your money is spread across a wide range of stocks and bonds. You'll only profit from stock dividends and bond interest, or if you sell when the fund's value rises with the market. To be financially independent in retirement in 20 years, the average person will need more than $3 million, and mutual funds will not get you there. When it comes to value, keep in mind that mutual funds are created and managed by so-called financial experts who struggle to outperform the market, especially when you consider the fees they charge you to manage your money in the first place. Number 4. US savings bonds and corporate bonds. When you buy a bond, you are making a loan to the entity you are buying it from for a set period of time and interest. Bonds are regarded as safe and low risk because the only way to lose your money is if the issuer defaults. Saving bonds in the United States are government-backed bonds that are almost risk-free. Bonds are issued by governments to raise funds for projects and operations, and corporations do the same. Corporate bonds are slightly riskier than government bonds because a corporation may default on the loan. Unlike purchasing a stock in a corporation, purchasing a corporate bond does not give you ownership in that company. It's important to remember that a bond may only provide a 3% return on investment over time. This means that when you withdraw your money from the bond, you will have less purchasing power than when you put it in, because the rate of growth has not even kept up with the rate of inflation. Number 3. Cryptocurrency. Cryptocurrencies are a relatively new type of investment. They are unregulated digital currencies that can be purchased and sold on cryptocurrency exchanges. Cryptocurrencies such as Bitcoin and Dogecoin have sparked a lot of interest as an investment vehicle in recent years due to their rapid and dramatic growth. They remain, however, an extremely risky investment due to the numerous unknown factors involved. There's the possibility of government regulation, as well as the possibility that cryptocurrency will never be widely accepted as a payment method. Cryptocurrency currently has no intrinsic value and could vanish as quickly as it appeared. Number 2. Bank products and certificate of deposits. Bank products are investment options provided by banks, such as savings accounts and money market accounts. Money market accounts are similar to savings accounts in that they earn higher interest rates in exchange for a higher minimum balance. Another type of bank product is a CD, or certificate of deposit. When you buy a CD, you agree to lend money to the bank for a set period of time in order to earn more interest than you would in a traditional savings account. CDs are a very low-risk investment. However, with low risk comes low reward. Most banks offer CDs with annual returns of less than 2%, which is insufficient to keep up with inflation. Number 1. Gold. Yes, you can invest in gold as well as other commodities like silver and crude oil. In fact, the practice of investing in gold dates back centuries. But this does not necessarily imply that it is a good investment. Because gold is a commodity, its price is determined by scarcity and fear, which can be influenced by political events or environmental changes. If you invest in gold, keep in mind that your moat, or price protection, is based on external factors, so the price can fluctuate a lot and quickly. When scarcity and fear are abundant, the price rises, and when gold is widely available, the price falls. If you believe the world will become more fearful in the future, gold may be a good investment for you. That's all for today, and we'll be sure to catch you all in the next one.